Brian, the nature of your job brings you into contact with thousands of clients around the country, around the world. So you have your finger on the pulse of how people are seeing the economy. Talk about the United States for a moment. What are you hearing from clients?
Well, it's not as much what we're hearing, because that's more on the institutional side. It's what on the consumer side people are doing. And we see that every week. We get a roll-up of all what they spend money on. And so the spending year-to-date in 17, whether it's cash out of the ATMs or over the teller, whether it's checks written, whether it's bill payments, whether it's debit or credit cards used, is up 6% over last year. If you look at the equivalent period from last year to the year before that, it was only up 3%. And what is driving that is just people are spending more money. And so, interesting enough, checks written's gone up, and usually it kind of comes down because people write less checks. And so, yes, debit and credit card is the fastest sort of big number growing, but overall consumers are spending well, and when they spend well, that kind of drives the U.S. economy, because it's 2/3 of the economy is a consumer-driven economy, and they spend, and then companies sell them stuff, and companies that are successful, et cetera, they invest in their house. And so that's very good news for the U.S.
So where are they getting that money from? Are they borrowing more? Or are you worried about credit?
I'm not really worried about credit on the consumer side, especially for us, because we stay in a very high end. But even if you look overall, there was some concern about excesses in car lending, and that kind of got pulled back. There were concerns about, it hasn't been anything in the mortgage land, because we're still working through, the memories of what happened before, and the conservative structure of what the industry does and what goes on in lending. A little bit in some of the unsecured lending, student lending, not something we're involved in at all in student lending. We're not really worried about consumer credit. It's pretty good. But that consumer group spending drives our economy. And so in the U.S., we believe we'll finish this year, about 2017, about 2.1, 2.2% GDP growth for the year, starting off with really zero in the first quarter, if you remember. It was kind of interesting. And next year we have that almost 2.5. And so that movement across this size economy is very big. The interesting question is the rest of the world's also growing. And this is the first time that you've seen Japan grow slightly, Europe grow a little faster in 1.5% range, China growing at 6%, India growing at 7%. Those big economies all moving together is tremendously different than we were 3, 4, 5 years ago, where Europe was plus or minus 0, Japan was negative, China had come from a faster growth rate down, which year to year incrementally means they're slowing down. Now they're sort of stable, moving out. And India obviously went down and up. Those things in Brazil moved in and out. Those things are very interesting. So now you have this worldwide growth, and that's good for the world, and the United States helps supply that growth across the platform.
So you're looking at something like 2.5% growth in 2018. Is that before the tax legislation or after the tax legislation?
The tax legislation just got passed today, so it was not including any benefit for taxes. And our experts would say that would add to that. How much, 2, 3, 4%, 0.4%, to bring it to higher twos is probably what they settle on that.
So taking into account the tax overhaul, you're looking at something like perhaps 2.8, 2.9.
That'd probably be at the high end. I think they'd be more 2.6, 2.7. Because it takes a little while for all this to kick in. The habits are there and stuff. But the tax thing for businesses in America is a strong statement, and they're going to be looking to do things. And then around the world, you've got Brexit and some other things that create interesting questions, but right now you're seeing the rest of the world okay, and we have it growing at high 3s.
Do you have a sense from talking on the institutional side to corporations about what they're likely to do with the money? I mean, we've gone from 35% to 21%. There have been other changes that really benefit corporations, expensing of capital investment. Do you have a sense, are they going to return that to shareholders and dividends and buybacks? Are they going to invest that? What's going to happen?
Well, I think if you step back and think about tax reform at the corporate side, the goal always was to really get an effective tax rate in the United States, which was competitive with the world. And what they were doing when we were in the mid-30s and the rest of the world was 20 and 12 or something like that, is the money was being shifted to where final demand is, this whole huge world of billions of people that are outside the United States that buy things, the ability to manufacture, ability to access the raw materials. So they were shifting their investment dollar over. That I expect to reverse a bit, and because we're now competitive. That was the core principles of the corporate side tax. When you talk to them about what they're going to do, my guess is you're going to see a little bit of everything. You're going to see some people buy back more stock because they have more after-tax profit. Some will invest in the business and build things faster than they would have otherwise. Some will fundamentally rethink their balance between inside the United States, outside the United States. None of this can be bad. None of this can be bad, because the money will go back into circulation if it's share repurchase or dividends, and the people who have it will have to go back out and invest it. If they invest in buildings and equipment and things like that, that'll create jobs to build them. So when you think about us, we'll accelerate some things that we were thinking about doing. Maybe a little more technology spending, maybe a little bit more in the branch side. We're building out hundreds of branches in markets we weren't in. Each one of those has 10 employees, but importantly, to build it, each one is a several $million construction project that has to be done locally in cities like Indianapolis and Pittsburgh and Cleveland and Columbus and Cincinnati and Minneapolis and Denver. That'll create jobs, and it will create jobs and pressure on wages that will help wage growth. And so in this connected economy, anything that gets people being slightly more aggressive is good.
So from your vantage point, the tax overhaul is good for Bank of America and it's good for the country. Do you worry about the deficit? Because we are borrowing a fair amount of money at a time when we're close to full employment already. Do you worry at all about the deficit we're running up for our kids, for our grandkids?
I worry about the deficit, and a lot of us have been focusing on that. The difference, the increment on this, no matter whose estimate you take, but the $1.4 trillion, $1.5 trillion against the total deficit is a very small increment across 10 years. The problem is the first 20 billion that got here, and 20 trillion, and how do we think about restructuring that? That's going to take some hard thinking. But when you give tax relief, it goes right back to the people who are paying the taxes. It's not being locked into spending levels. It's not being capitalized into ongoing budgets. So the good news is this money goes right to the people who pay for the government, and they will do something with it. Whereas if you just have increasing spending levels, increasing the deficit, it's hard to get that money out of the system. And so we have a serious issue about the debt here. I'm not sure this is going to affect it as much as the first 20 trillion that got us here, and we have to deal with that, and we have to continue to work that down as a percentage of GDP and all the factors people look at.
But that sounds like we're going to have to address the spending side at some point. And there's discretionary spending, which is something to be addressed. There's also entitlements, which really most economists say that's what's really going to hurt us. Can we come down off of that sugar high without really hurting the economy?
Well, I think there was a lot of work done in the last administration about entitlement reform and potentially needs testing of people who are wealthier, and there's a lot of ideas there. There's a lot of the money is spent on medical, and getting that straight is going to be interesting and how that works. But there's a lot of ideas out there. We now got to go start to look at them, and the key is to do things which have arcs of 10 and 20 years, because you're not trying to change this overnight. You're just trying to clip it and let the economy catch up and then compound through it.